Hi, everybody. We have a special guest today. I've interviewed Francis Hunt at least a few times, been aware of his work for many years, and it's really an honor to have you here, Francis. I appreciate you being with us here today at TradeGate Hub, and markets are busy, so thank you for giving your time today.
Absolute pleasure. Delighted to be with you and your awesome community, Dale. Thank you for inviting me.
And last time we talked, you had a smile on your face, and you were in Panama. And I don't know if it was vacation, but I call it a paid vacation because when we talked, it was before the invasion, and you were long US dollar ruble. You were long the gold. I forgot what else you were right on going into that invasion. But, great trades, great analysis, excellent call, because there were some people that thought he may not go in.
Yes, we were lucky. We had, Dale, we did a 6 macro reset trades in September of last year, 23rd of September. And when I spoke to you, I think I gave you a quick flyby version of those. The one you missed in there, which has also been very relevant, was shorting the yen as well. This was in September. We said
monster
short the yen. We chose the USD, but the USD has been reasonably firm. It's not been the out and out strongest currency. And we tweaked it a little bit to the Aussie yen, or slightly more recently, the Australian dollar. Just on that theme, if you're okay with me just running with a bit of a theme that might be of interest to the guys, is we're very much in the end of debt cycle. Debt is the big story. So we were watching the bond markets. Everyone should be aware that we're probably on the verge of inversion on the 10s and 2s, which might be a bit crazy speak to some people that aren't familiar with the bond markets. We can delve into that if you want to, but the key thing is debt is currently guaranteed to lose money. We've got a runaway train that is inflation, and Jay Powell saying he wants to stabilize the world in terms of this, and he's missed the train. He's totally behind the curve, and he's taken 3 steps on the railway track to follow this runaway train that's going at 100 miles an hour. It's one of these Japanese superstars. And now he's stopped for a coffee before he takes another 3 steps. So that's my perception. There is no.
Okay. Let me ask you about the train. Okay. Maybe he could be effective on the cars, the storage cars on the train, with economically sensitive commodities by creating a recession and demand destruction. But there are certain carloads on that train, in my view, things like wheat, things like cotton, things that grow that the Fed can't print, that raising rates to 20% would have no impact on. Do you agree with me on that, Francis?
Absolutely. And this is why, bringing it back to the FX trade, we're facing a grand macro commodities long, almost regardless of major destructive demand events, which I still think we will encounter. So there is a real event risk. Most of the risks are to the downside, hypervaluations on equity. But the superinflationary game is the underlying trade that people will need to hold on to. And that's why we're seeing the likes of the CAD and Australian dollar do better than the dollar. And you're seeing the one that is known to be the highest debt-based nation got the 2 terrible twins in the Ds of terrible demographics, very aging population. So growth is driven by demographics.
Yes.
One young, and that was the US baby boomer.
Like us, guys like us.
Absolutely. And Japan is just further into the aging population than America, and has 273% debt to GDP. And now debt markets are unraveling everywhere, and they've had the lowest interest rates long before we went to zero. So the yen has run into serious trouble, and there's a lot of intervention going on through the Bank of Japan, and they're damned if they do and they're damned if they don't. They either buy their own debt and devalue their currency by doing so, or they let their own debt rates go up. They
haven't done that for how long?
Decades and decades and decades, so that was the yen part of that. And the ruble has almost played out. I mean, we did a pivot on the ruble after our targets were made. Yeah. It was actually a great short because you're getting a huge positive carry on that trade.
It went to 160. So I wanted to ask you about it because, this was a very unusual market circumstance because we've never weaponized the SWIFT system to this extent before. And were you able to trade through your broker and get trades off on the invasion, and were the spreads just phenomenally wide? How did you handle that?
Yeah, so the key thing for trading that successfully is you had to be early. That's one of the key aspects of HVF method. One of our golden rules is be early. That means you run a risk of being wrong, but we choose those very select low volatility moments where the price for being wrong is very small. In other words, the trade invalidation for a stop run is low volatility squeezes. And
right.
we were, that's why we were discussing this in September last year. You had to hold that trade for, all the way through Q4 to get your gains in Q1. And that's patience as well. But then you also had to get out. This was the second part.
How was it to execute the liquidation of that long?
We've done this on the lira prior to that. When you get the major blow-offs, there will always be such an overshoot. And what typically happens is brokers then are setting markets to close only. You can't put the trade on anymore. Usually that's the time when you want to start thinking about even a possible tactical short the other way, because markets overreact. And those trades, you get a positive carry on because the interest rate differential moves immensely. So, and brokers are usually welcoming that. You can actually go the other way and provide dollars and go long the lira, or in this recent case, provide rubles and go short the dollar. And what you've seen is the entire USD ruble has come all the way back. It might be
160 to 106. We're right back to invasion levels, aren't we?
Exactly. And that it might be worth just sharing the chart with some people who don't visualize it's a little bit of an eccentric trade to some. It's not, it's not the first FX pair everybody looks at necessarily, unless you're seeing the event risk. So give me a moment here.
So I know people that were bullish Russia and the ruble prior to the invasion that were looking to, their big play for the next few years was going to be long rubles. And maybe that happened on the invasion. It would be classic that the ruble bottomed, or US dollar ruble peaked on the invasion.
Look at that. Very much like that. It is very much like that. So let's just, I'm going to exponentialize the scale because it's almost a ridiculous curve. So this was our original setup. Let's just get this. I won't even go, whoops, weekly was probably enough, and just rescale that. So here was the original high. Now, the original highs came with the 14-15 Ukraine event. So we've actually sat an entire cycle out of Ukraine-Russia drama of 8 years while they programmed the Ukraine people to hate their old brothers, cousins, and uncles. And then gone into
quite an accomplishment.
Yes, it was. And they 8 years of media. So you had, this was your September entry that we were talking about.
Is there a funnel there that you could show us?
Yes, there is.
Why? Okay.
So let me illustrate this. I've got an overlay raw. In fact, I'll go to my favorite color, transgender pink, there, so that everybody can see it nice and be woke at the same time. There you go. That green line, and let me just get the Zoom picture out the way. Sorry, we've got our handsome faces all over the place here. There we go. So this right here is the key event of the break, roughly at the beginning of 2022, but you only started hearing the Biden, Russia's going to invade Ukraine, Russia's going to, this very predictive, well-informed information and repetitive information that was talking in the manner that it was, around about February, March, coming into March. And I think we're about 6 weeks in, maybe into this conflict, maybe 8. I'm not too specific, but here you can see you already had the break around about January. So this structure. Now, we had follow-up, all-time high and overperformance management that would have got you out of this trade in and around the 140s. And then there was an opportunity to get short. I'm going to drop time frame so that everybody doesn't lose the thread here. That's the big time frame. So if I just take you all into 4 hours, drop into 2 hours, drop into 1. This is very common, and we expect this. And as I said, you got the same with the lira. They take such extreme defensive measures that it becomes too expensive to to short this currency. The late people get hammered. This is what we call blow off.
Yeah.
And then you get the slap in the face event, a major snapback. And then you get a setup squeeze, which is your first setup in a new trend. And you can see we funneled again. Stop at the red, green is your short, and you go back there. Look at our interims. We get two clustered interim, a first and a second. You see that box that you stalled there for a while at the two pattern. Whenever you get the two interims very close together, you tend to get a sustained period of hang time. And then this is the final target, which is of this reversal. And you'll also note it bounces on the original target of the main pattern. We talk about this being a key level of significance. I mean, if you want to see HVF method in operation, I'm busy showing it to you. I don't think there's any more. Every aspect of our theory. Look at how this served as support. Just let me just highlight some of this. You made the target. See how support, support, support. Then you had your overperformance period, which you would have harvested some of because we have overperformance methodology for that using trumpets, which are broadening structures and slides, which are the equivalent on the bear side. Then you get your slap in the face event. That is a severe warning that things are due to potentially change. Bang, the slap in the face. Then you get the squeeze and the dangerous hang at a level. You are holding the 135, 130. Then the news, Russia starts to react and says, okay, guys, buy my stuff in rubles. Let's create a market for the ruble. Now it's time to buy. You want that gas in Europe? Buy in your rubles. We don't want your euros. Your euros are toxic currency. We have gold, we have energy, and we don't have debt like you do. Why do we want your confetti? Pay us in ours. And what do you then get? This
right. You know, you bring that up, and you know, this was very draconian. And do you think that because we weaponize the SWIFT system, that other countries are definitely, that's a shot across the bow about them needing an alternative? I know China's been working on one for quite some time. Do you think this plays into more de-dollarization down the road? You know, where people aren't going to trust us. I think even the senator came out and said that foreigners should ask for their gold back from the U.S.
Oh, absolutely. This is an accelerant and a loss of trust. I mean, it's a bit like you're in a long-term relationship or marriage, Dale, and every time you're having a bad day, you say to your wife, that's it, I'm goddamn, one of these days I'm going to goddamn leave you. You know, eventually you threatened her like that 5 times in a row, and you're wobbling the entire foundation of your relationship. You might come home one day and she's packed up and gone with all her stuff because she thinks you better get a preemptive strike in there and move away before you pull the rug at a very inopportune moment, maybe when she's sick sometime. If you're going to become that guy that shakes the foundation that hard and is so threatening, well, don't be amazed when people out of natural preservation make alternative arrangements. So it is intentionally, and I think this is via intent, not incompetence. Most people want to put this under the category of incompetence and end of empire, and they're all just giddy with power and all of that. It is short-termism, which is deeply undermining long-term, and it's understood and it's with intent. In short, these people are captured people. I don't think they work for America, in my opinion. It is absolutely damaging to the dollar and de-dollarization. It might sound too conspiratorial, but that's my take.
You know, I wanted, you know, I wish I had hours to talk to you, but do you have any comment on President Biden signing an executive order for a US dollar crypto coin and for them to have something developed in the next 7 months?
Well, central bank digital tokens are the way. The big delusion that was the crypto revolution, and one of the biggest delusions as part of it, is that this is privacy. This is surveillance finance on a way that you've never seen it. Cash is your biggest friend, Dale. I can come past and buy your car secondhand and give you cash. And that transaction's nobody's business except you and me. The minute we go this open source blockchain searchable, where it goes from my wallet to your wallet, whether it be a Bitcoin or a USDT or some future CBDC. Someone can come to me 10 years from now and said, what were you buying? And ask you, what was that income? Maybe it was income and it's taxable event. It is an extraction mechanism. At first instance, it's all about extractionism. And unfortunately, the more the information they have, the more power they have over us for extraction.
Yeah.
So I'm
write your congressman, everybody. We don't want this coin. So this is this is like the nuclear option for the war on cash that's been ongoing for many years.
And that's the de-dollarization and the forcing the fiat failure of the dollar as world sacred currency and shaking the SWIFT system and all the people, you can't play on it anymore. This is absolutely leads and feeds into the central bank digital token. Oh, we need a new system. Oh, guys, we've got to reset the clock. Oh, debt. Oh, yeah, that problem. Let's all zeroize that. You can have some UBI instead of your pension. Oh, but to get your UBI, by the way, you might need to, comply with the farmer mafia, various other diktats, etc. So this is a draconian Bolshevik event. You get these two, communism and capitalism. It used to be very stark after the Berlin Wall, how it all played out. What you actually get is thesis, which was capitalism supposedly back then, and you had communism. And what you actually get is antithesis when you are getting these two competing systems. You merge into one. We're getting much more Bolshevik tendencies in our supposedly capitalist nation. And actually the capitalist currencies are, the ex-communist currencies, are actually taking on some free market principles. And what you get is a synthesized free markets for some and Bolshevism and communism for others. And
currency
I don't like
controls.
the direction. It's pretty dystopian.
I mean, Orwell had to take a tranquilizer when he was looking down on us. So, Francis, we're talking about a lot of unprecedented things and cycles converging into things and scenarios that people have been talking about forever. Okay, so what that means to me is the trading opportunities.
Absolutely,
because I can't control what's going to happen in the
Let's
world.
Bring it back. Exactly.
Yes, but the trading opportunities are probably the best we've seen since the 70s. We now have volatility back into the currency markets. That's been missing for a long time. Reality is setting into the biggest bubble in the world has been debt, especially negative debt, interest rate debt. That makes the stock markets look like a dwarf. And the biggest market of all being the currency complex, the deepest, that all wars and trade wars and competition is going to be played out in the FX arena. Do you agree with me?
100% do. And I think your framing is right. I'm not here to depress people. I'm here to say, build some wealth. There's opportunity created in the unraveling of an aging system. Let's talk about those opportunities. Going back to that AUDJPY trade just for a second. This is on the monthly, and this is a secular reversal in our opinion. This is so big. I'm going to get a specific website that specializes in lengthy history. I'm going to take it right to the bottom and show you how the yen was the all-dominant star due to manufacturing. Till
the 90s.
Let me just get rid of the Israeli shekel there. I was watching that too. Let's get the Aussie up. Here we go. AUD. This is super long history. I've done this intentionally and not the dollar. We want the Japanese yen. In fact, my apologies. I'm getting this wrong. I've got to do the Aussie first. Give me 1 second. It's worth getting occasionally some super long history.
I love the Hubble telescope.
Absolutely, it is the Hubble telescope. I love that. I'm going to steal it because this is how you get perspective. So AUDJPY. So let's go let's see if we can get in the vicinity a little more efficiently. Jersey, Jesus, currencies for Africa. Yeah, there we go. So this is, we're getting a semi-serious charts from the 70s. So let me just get rid of the 50s there, and we get you in at around 73. This is the JPY. strength and the Australian relative weakness due to manufacturing in this chart that you're seeing here. It has all been one way. This is the Japanese miracle of manufacturing everything, making everything smaller, better, faster, high quality, the Toyotas and the Sonys of this world. But then they had their debt issues. We are now here. And we are now secularly going into a 70s based. So let's be clear, this is 1970. Essentially the back end of going into 80, the gold highs that was all.
I'm still seeing the chart that you're pointing at 2012 right now.
So we're on Zoom. Let me
we're on Aussie yen, but I believe it's a it's a monthly.
It does. Is there a green outline to this chart, or is it?
No.
Okay,
no.
I think the Zoom is inside my browser. Let me.
Okay.
I'm using TradingView, so sorry.
That's okay.
The long-term chart that I've got is in the browser, and I'm using TradingView, and it seems it's only.
All right. Well, you know, I want to turn it towards. You could lay out a perfect trade to somebody.
Yeah.
And they, you know, and they could have entries and risk management and targets, and they still could end up losing money because of their psychology.
So one of the big things Paul Tudor Jones says on that, and I'm glad you brought up psychology and all of that, is the time frame of your thinking and setup must match the time frame of your view. It's when we are impatient and small and we don't ride out. So let's just use this as an example, because this is a macro trade. So say I say to everybody, guys, we're going to run the 134 on the AUDJPY. Bear in mind, we're at 91 at the moment. That's a massive move. That's about a 35 going on maybe 40% move in currencies. And let's assume, for example, because as I say, we haven't done badly on the FX call trades. You go look at the 6 macro FX trades on YouTube that we gave in September, and you'll see most of them are deeply in money. So if you do that, if you say, right, okay, I'm going to stay in this trade, what you've actually got to do is not tinker with it when it rests. So I'll just highlight a couple of things. We get setups within setups. This is your big setup. So let's just clarify. Start always macro, Hubble telescope, as you said so nicely over there. This is
how do you get people to not tinker with it and detach from a long-term position trade?
People tinker because of sizing, Dale. Okay. What happens is the swings in their P&L are too significant. Even for a macro trade where you long-term are going to 134.8, let's say, and there's overperformance on this trade, by the way, it's a first setup in a new trend. So you could get a degree of the Russian ruble. They will break it and spoil it, and I've even still done that myself. It's so hard because you want to kill it on that trade. You calculate, I want to make €1 million out of this thing. Therefore, I'm going to put on that much. And the distance to your stop is, a $25,000 loss or a $50,000 loss. And you then it starts going against you for a bit, or it starts taking some profit back, and you think, damn, I know it's going to do that. I'll just get out and I'll get back in again later on the lower point. What do that is, as you get out, it starts going in the original macro direction very quickly thereafter.
Or you turn your head for 2 days and it goes without you. Is taking partial taking partial profits a good compromise?
So here's how I would have managed it, because that actually is handled. That question is handled. You see the big structure here? We call the big structure. There's the first green line and the first red line. That's your entry and that's your stop there. Now, if we drop down into that, I will show you how you might have been able to do a little bit of that. But generally, I'm not a fan because it's going to shake you out of the trade. Don't get shaken out of the trade generally. But if you get a gift like this, now we're in the funnel, as we call it. This is your macro. So I'll just make these this super fat so that they don't get confused with the other one. What you ended up have happen here is you've got a squeeze within a squeeze. This is a primer. We teach this. This is a real gift because your risk stop can come up to this red level. That means you can increase your sizing. Plus you get in earlier on the earlier green level here.
Before the major breakout.
Correct. And you see this little structure, which is the primer that we refer to, is in the funnel there. And it had a cluster of targets. So we say, after running this, you're likely to get a blow off and pullback. What did you get? Final blow off everyone, it starts making the news. Everybody's talking about the Aussie JPY, and now you're getting a bit of a pullback. And these cluster of key levels say this is a good point after the running of this to take some off. So you could have got out on overperformance as it blows through that and got back in on the basis of we're likely to have a rest, and we could even pull back a little further here and come back down. So the people watching this right now could even get the original just-in-time entry if we pull back far enough. I can't guarantee you that, but you could. Limit orders are your friend, as ever. You could break into this trade.
Would you scale in with small size at different
small.
fib levels?
Very small, and on pullbacks, look for other key levels. So we've got a bit of a 38.2 fib from the very significant fib levels that I've drawn. This is the, in fact, I think it's 61.8. This is the 50. I'd intentionally make it black, the 50, so that we can see the halfway mark. This 50 confluenced perfectly with our stop on the primer there. You can see this. So again, I'll just go back up to show everyone that entire structure's Fibo levels, how it formed, where with all the key inflection points were. We go back up to the monthly, you'll see why that was. From the high to the low. That was your last big macro sell-off, and we're calling that the final low against Australia. And then you've got the structure. So that was your low. That's naught. That's 100. You can see your 50% is bang on that stop, and your 61.8 you've just run with this confluence of levels. Look at how this wick is forming after running these confluence of levels. So your small time frame setup. Now you get a little bit of pullback. Will you make it back to the 61.8 maybe, or maybe all the way to the just in time? Be light buyers here and make sure you keep a stop down here and just forget about the trade. Put in small size. The move makes the money, not the sizing. If you make it too sexy for you that you're having to watch that P&L, your sizing is too big. Anytime you're trading your P&L and watching the P&L swings and you're going, oh, that's significant, oh, that's a lot, you're too big. Cut it down, cut it down, cut it down. And get it to the point where you're almost indifferent and it's not interesting enough to watch. Come back in 3 months' time and smile. You know?
Someone once gave me a tip, because I have that tendency to, but I'll take partials. They said to me, Francis, tell me what you think of this. That Dale, when, say, for example, you're long, you're making money, you're tempted to go out, ask yourself, would you reverse here? And if the answer is no, you walk away. Yeah. And you know, it actually works because, you know, I wouldn't reverse. So if I wouldn't short it, I may as well just sit with the position, right?
100%. And in this particular trade that we're discussing, I wouldn't reverse at all. It's absolutely at no point would I reverse, because it can just kick off when you have the macro wind in your sales. It's something worth keeping. I'll just post that macro 6 trades in the chat for you if there's any of the viewers, Dale, that want to grab it. Because of the other browser.
And why don't you put your website address in there too?
Absolutely. It's themarketsniper.com. I'll post that for you. Any questions else on psychology? Because it's something I went and studied quite a lot. I felt very, I want to say this about myself, just to give other people encouragement. I'm exactly the wrong guy to be trading. I was emotional. Biologically, I'm up and down. If I haven't, you know, like sugar cravings and fast metabolism and ups and downs, you know, some people will describe you as moody because, you know, I'm very dietary sensitive with this fast metabolism. This is the worst combination for trading. It's somewhat emotional, you know, reads things into something that maybe isn't there. You know, all of these sort of kind
paradigms.
Exactly. And these templates, and I having process overlay you, because you are your own best friend and worst enemy. If you've just been told, it was my birthday yesterday, by the way, Dale, so I was out for dinner and there was some drinks. If I came in slightly toxic with a bit of a headache and I start laying on lots of trades, you have that cranky aggressiveness.
Don't trade and drink.
Nothing good comes of that. Yes, I'm very moderate nowadays. My body can't take it. But I mean, I had a couple of cocktails and even still had a light headache this morning, like literally 2 cocktails. And it was, you know, my partner put on lots of people to visit. So you do. It's a worst situation to do anything. You have to to be the notion that you have these flaming Ferrari slurping guys that are multi-millionaire traders. That's brokers. Every time you read those stories about Wall Street, getting drunk and at strip joints,
they don't have to be right.
They don't have to be right. They just take flow. The real money managers, those are the guys that run biathlons, triathlons.
Yeah. You do have to be an athlete to trade, don't you?
You absolutely,
in a way.
You need to be biologically healthy. And this is a great US guy, I'll give him a shout out, Rand Howell, that I went and met and trained with. And he said, there's this philosophy that mind over matter. Your mentality will dominate everything. It's absolute nonsense. And he mentions the guy that always says it. He says, if you come in biologically under, you're lacking glucose, you haven't had sufficient sleep, there's some element of toxicity in you, whatever the case may be, it absolutely ruins your process of thinking. It makes you more snatchy. It makes you everything. It will ruin your trading.
How about your paradigm as a child? What if you came from a poor family and you saw that they always worried about money and you're always worried about, can we make it? And then you become a trader. Sure makes it hard to hold a profit, doesn't it?
It can do. There's two things that possibly come out of that. So one that is very common is the Protestant ethic that says, I've sweated like a dog for every dollar I've ever earned. That makes
the tough money
trading feel immoral. So there's a moral virtue attached to money where, every penny I've sweated like a dime, as if there's something smart in being an absolute slave dog, working and bending your back. And we carry that. I had a bit of that program because my father was not a trader. He was not a trader. He wasn't in business. He came from the UK where everybody got jobs and worked hard and 9 to 5
in the mills.
And guys that made fast money were evil in some way. They were ripping people off. They were overcharging. They could have done it for cheaper. There's this underlying socialism.
You're right.
My
mom told me, honey, get a real job.
Yeah, exactly. There's this Protestant work ethic that just says you shouldn't be paid for that. It's screen jockeying. You're stealing money from somebody else. It's some form of zero-sum game. You have to deal with that program and see a virtue in it. If you don't, you actually think you're a long-term pickpocket that deserves to be caught out. And you end up giving all the proceeds back. So in terms of
you don't deserve to be successful.
Exactly, it's immoral. People who are immoral, we all have a moral code in some form. In other words, you have to squander it all and do one last big gamble in entertainment to do it.
Or how about if you're a silver spoon person and they don't really know the value of money and they're out there over leveraging, and so what? I lost 100 grand.
Yeah, well, that's also very destructive potentially, because money management then becomes the thing. And the key aspect with trading is we underestimate the endorphins, the thrill, the activity of being in the game. And even when you're having a losing streak and you keep making bad decisions, you want to fix it. And that's very dangerous. That's where revenge trading concepts come in and all sorts of things. Actually, you want to disengage because you're not in the state of mind where you're in flow. The feedback from the market is you're not in flow, dude. The picture you got ain't the right one. And what do? My picture must be right. This will eventualize. So you end up brute forcing something that isn't meant to be brute force, like trying to nail a screw into a square hole. You've got to stop what you're doing. And people can't do that because the minute you stop, you feel this sense of depression. It feels like you've given up. It feels like a failure. We don't ever want to accept failure. Hey, feedback. The market is giving you feedback all the time. You're wrong on this one. You're wrong on this one. I mean, the one thing that's also important, you praised me a lot, and those 6 trades, as I say, that I've shared, they're all generally good, but we've got stuff wrong. The gold, I thought it would take another dip before it rallied, and it went straight to going up. It's a little bit the same with Bitcoin. I thought risk needs to be hammered again and that we're going to have this event. We weren't accurate with that. That's a feedback thing. You don't try brute force Bitcoin down or gold and silver down because it's going to have one last dip before it goes up. Reframe.
I do that.
Exactly. You've got to reframe.
All right, so let's encapsulate. It's kind of a question I asked Schwager. And I said, what's the most important advice that you can give a trader? And he said, find a trading style that suits your personality. If you had one thing to say to people to wrap this interview, what would it be, buddy?
Submit to a trading process and don't tinker with it. That is your great gift. And the key thing about a good trading process, which I believe we have in HVF method, is that it has a tight stop that allows reasonable sizing, even with small losses, and highly expansive gains. There are not every moment in the market is a trading moment. In fact, the more of a sniper you become, the less you shoot.
Tom Petty says that the waiting is the hardest part.
And he's spot on. I would say that you can throw that one in with what I was just describing. The sniping is a special. I'll just do the infantry comparison. An infantryman, you know, let's take Vietnam. They had automatic weapons. They fired lead in the trees. Yes. I think I mentioned before, 1 round in every 450,000 actually took a casualty. A sniper is 1.3. But one of the reasons it was like that is he rarely shoots. But when he shoots, he's expecting a headshot and he's expecting it between the eyes. He's almost missed a little bit in his own books if he just gets the headshot and it's not between the eyes. In other words, such must be your certainty. Now certainty is dangerous, but such must be your conviction, let me say. But excessive certainty and conviction can be dangerous, and you have to have your backup plan. So the sniper always knows if the wind suddenly picks up, he sees externalities. It's a long distance shot. Nonetheless, anything can happen. He can get the hell out of Dodge real quick because you're usually behind enemy lines. So exit strategy. So the whole military analysis there, very specialist weapons, high, if it hits, it kills, but he's got an exit route. He's got to have an exit route. The whole thing is planned. In fact, they were reconnaissance guys. Snipers were generally reconnaissance guys. They watched and they had a spotter and they watched and they watched and they watched. And it was 99% watching and 1% shooting. That's why they had 1.3 when the average guy that had a gun was 1 out of 450,000 in Vietnam.
Well, Francis Hunt, the market sniper, I'm glad you're my friend and not my adversary. And what a, you know, interesting, compelling interview with you, Francis. Thank you for your time today. I consider you one of my trading warrior brothers. High respect for your work and really appreciate your giving nature to share with us your life journey and what you do now. Thank you so much.
Absolute pleasure. Thank you for having me on.
Francis Hunt, everybody. Hope you enjoyed it. You could follow him on Twitter at the Market Sniper. He's left some links for you guys. Check him out. He's a pro. Thank you, Francis.
Bye-bye.
Adios.